record this to the cloud. I am a little behind on some of the recordings, so I will catch that up here in the next few days. I'll be able to get some time to put up the back recordings and of course tonight's class as well. Okay, all right, great. So let's go ahead and let's take a look at our chapter 7 material here that we still have left, which, as I indicated, was the statement of cash flows. Okay, and I've sort of forwarded us a little bit past the initial introduction because I don't think it's necessary to repeat everything we said last time. But I do want to quickly review that last time we had said that we could use the direct method or the indirect method to prepare the statement of cash flows. Now remember, with statement of cash flows, we have our balance sheet, we have our income statement, and then we analyze the balance sheet and the income statement to generate the statement of cash flows. FASB allows two different methods. The direct method is the preferred method, but most companies use the indirect method. Most questions you see on the exam will focus on the indirect method, but we are going to spend a little time considering the direct method as well in case you do get some questions that contemplate that. So just taking a look, and we talked about, and by the way, you see that there's a balance sheet and an income statement here, and you're going to see, we're not going to go through this necessarily together, but you're going to have, I'm going to have an expectation that you'll spend some time on your own going through the analysis excuse me, of the balance sheet and the income statement to allow you to generate the statement of cash flows. You'll see that there's they actually show you what it would look like, but you should be able to do that on your own. Now, when we look at the operating activities, that is the area of the statement of cash flows that is different depending on whether you're using the direct or the indirect method. There's also the financing and investing section of the statement of cash flows, but those are the same under both methods. There's no difference between the financing and investing section of statement of cash flows if you're using the direct versus the indirect method. Now, when we look at the operating section under the direct method, we are going to be needing to show the following items, and I asked you last time to flashcard what goes into that section, and it's cash received from customers, interest received, dividends received, okay, other operating cash receipts, which I don't think you necessarily need to put that on the flashcard, but cash paid to suppliers is a big one to put on the flashcard, okay? And then interest paid and income taxes paid need to be shown on the statement of cash flows. And of course, if it were interest received, other operating cash payments, and if it were interest received, you would show interest received there. I'm not sure. Interest paid, where's my interest received, and dividends received. Okay, so flashcard those ones that I've highlighted so you know that those are key parts of that statement of cash flows. Now, that's a high level flashcard, but I also want you to prepare flashcards that allow you to calculate some of these key ones here, which is cash paid to suppliers. Okay, now when you look at this, it's a little confusing and I think hard to flashcard exactly the way they've shown you here because let me go back up actually to the first one here. I want you to make a flashcard of this one. So flashcard the high level 1, 2, 3, 6 like that, but then flashcard these. But it's a little hard when you see these because you think, okay, I should put minus, plus, decrease in receivables. Well, look, the receivable can only increase or decrease. It can't do both. Okay, so I think it is easier just to say, well, for the change in accounts receivable, and you can see that you should do what? Do the opposite. Okay, so if the receivable increases, you should subtract it from revenues. If it decreases, you should add it. Okay, do the opposite. Okay, to me is easier to remember. I don't know if I'm spelling that right. I don't care. It is easier to me to just remember do the opposite or do the same. Okay, so if it's unearned revenue, it'll either increase or decrease, and so you take the change and you'll do the same. Okay, and that will allow you to quickly, if you're asked something about the statement of cash flows in the direct method, to come up with an important line item on the statement, which is the cash received from customers. Okay, now when you look at inventory, okay, when you look at inventory, I mean, a cost of goods sold, and you want to get cash paid to suppliers, you want to get cash paid to suppliers, and I want you to flashcard this. You start with the cost of goods sold, and then you want to look at the change. And for the change now, you should do what? You should do the same, right? You're going to do the same because you can see if it increases, you add it. If it decreases, you should subtract it. For the accounts payable, again, it either has to increase or decrease, and you see there that you should do what? You should do the opposite. Okay. Now, trust me, these rules work, guys, and I know sometimes it's a little bit hard to kind of just comprehend it when I'm just telling you to put it on a flashcard and do it. But if you have trouble and you need a little more, discussion in your mind to help you, just go ahead and come up with an example. Cost of goods sold was this. The inventory went from this to that in year one, from year one to year two, and see that it plays itself out if you follow these rules. Okay, good. Now you come over, and when we're talking about cash paid to employees, another important line item under the direct method, okay, and you should flashcard that for our salaries, for the salaries payable, do the change of salary payable, and you can see there that you are to do the opposite. Okay, I'm doing this, guys, just because I think this is easier than plus minus on a flashcard. To me, just gets a little busy. What's the change? Do the same, do the opposite, right? Okay, so much easier in my, I have enough voices in my head that I don't want to add words already to, the things I hear in my head all the time. So let's take a look though at other operating expenses, and notice we have prepaids here, okay? And so the change in prepaids, we should do what? We should do the same. Okay, and for the liabilities, take the change and do the opposite. Okay, in case they give you a bunch of other ones and you want to sit there and just list those as other operating expenses, or you get a multiple choice question and ask you cash paid for other expenses, that's how you would handle that. Okay, to me, that's the hardest part of the direct method. And if you're feeling like you're having deja vu, not only that we talked about this a little bit last time, but remember back in chapter 2, we talked about converting a set of accrual statements to cash statements. Same rules applied there, and I gave you some examples of how to handle some of those questions. Of course, here we're going the opposite. I should say chapter 2, you could also have the opposite, which is what? They'll give you a set of cash, and then you do accrual, and then you have to turn all these rules around the other way, right? Okay, so that's something to keep in mind with the connection to chapter 2. Okay. The most important thing, guys, when it comes to statement of cash flows, okay, because I think a little bit, and I think this is part of why you guys wanted me to go through this with you. There's, preparing a statement of cash flows is kind of like, I don't know, tying your shoes backwards or something. I don't know. You know how to tie your shoes, right? But if someone asks you to do it backwards and under pressure on an exam, you start to freak out a little bit. Okay, so keep in mind that if you are given a simulation in which they're going to give you a balance sheet, an income statement, and additional information and ask you to prepare a statement of cash flows, don't sit there and feel like you have to make the statement of cash flows perfect. You're not doing this for work. You're doing this for an exam in which you're trying to gather points. So if there's a few things that you don't remember, you can't figure out, just move a few lines down, leave those blank, move a few lines down and put in what you do know. You get points for what you do correctly. You don't get points for being, you would get points for being perfect, but we're not trying to be perfect here. We're just trying to gather points. So if you get stuck on something you don't know, don't freak out. Just sit there and keep going with the things you do know and gather as many points as possible. So your statement of cash flows may not balance. You'll know what the change in cash is. You'll go through and you'll figure out your cash for operating, investing, and financing activities to prepare an entire statement of cash flows in a task-based simulation, and it won't balance to the change in cash. So what? I know that if you turn that in for work, they'd call you in and say, are you having problems at home or something, but for the CPA exam, that's a gathering of points, and that's all we care about. Okay, so you should practice with this example, and that they'll give you some information and they'll ask you to go ahead and prepare the statement of cash flows. And they're basically giving you these different items here as the solution. And you would have used that income statement, that balance sheet that we looked at earlier to help you to prepare this statement of cash flows. And they also show you some calculations. Okay. Now we're going to, in a second, look at the right now. In fact, we're going to look at the indirect method, and you'll use that same information to prepare a statement of cash flows under the indirect method. So do it for the direct method, do it for the indirect method. Questions so far? Okay, let's look at the indirect method then. Okay, let's see what that has to offer us. Okay, and I'm going to jump straight to the shortcut. Okay, because this is the way to do this, guys. Okay, if we have a debit balance account, you will do the opposite. Okay, so you'll start with net income, and you're going to reconcile from net income to cash provided by operations. And when you're making that reconciliation, so start with net income. Maybe I should write that somewhere for the indirect method. Did they tell us that up there? Indirect method. Net income is adjusted to arrive at cash flow from operating activities. And by the way, there will be supplemental disclosures of cash paid for interest and income taxes. Okay, so you will need to disclose that. You still there? Can you still hear me? You can hear me
now.
Okay. Guys, I'm just going to go without the visual then, as long as you can hear me, because I have a feeling that it's going to start making me do all kinds of weird things if I try to bring the camera back. So you can hear me though, right? Okay, so just don't worry about the camera right now. Okay, now what happens? You will then make adjustments to net income, and the adjustments to net income that you'll make, you'll have to disclose information about the cash paid for interest and income taxes. But then you come down and under the direct method, you have to call those things out specifically in that operating section. But here we just will make a supplemental disclosure regarding that. But then the shortcut cash flow, and it's basically all of this is a shortcut way of looking at it. It's a change in a debit balance account. When we say debit balance account, we mean an account that is increased by a debit. Okay. When we say credit balance account, we mean an account that is what? Increased by a credit. Okay. So assets are increased by debits. Credits are increased by a credit. We'll do the opposite. Mess with me. I can see that. Hear me?
Your audio is cutting out.
Okay. Let's see. How about now?
Yes.
That's better.
Yes.
Okay. I'm scared to try to start the video. I have a feeling no matter what I do, I'm going to end up screwed one way or the other. Okay, but let me just try to keep the camera off, and you can still hear me? Okay. Okay, good. If we're talking about credit balance accounts, okay, then do the same. So if they increase, you'll do what? You'll add them to net income to reconcile the cash provided by operations. If they decrease, you should do what? You should subtract and do the opposite. Okay, that's for the credit balance accounts. Now, gains and losses, okay, and gains and losses, you really could say do the opposite. So if it's a gain, you should subtract it. If it's a loss, you should add it, right? So if we sell equipment for $500 and its book value is $400, well, that's a loss. But what happens? We act. If we sell it for $500 and its book value is $400, that's a gain. But we didn't get $100 out of that. We got what? We got $500 out of that. So you'll get and selling equipment is a non-operating event. So you'll do what? You'll subtract that gain from the net income, but you will put the entire proceeds, the $500, down in cash provided by what? Cash provided by investing activities. Okay. Now, if we're talking about losses, of course, you will, of course, add the loss. Okay. So really with gains and losses, you could almost continue that, do the opposite thing. For gains and losses, you should do what? Do the opposite. Okay. You should subtract gains and add losses. Okay. And then you come down and we have this nice mnemonic for you, which is CLAD. And so you'll analyze current assets and liabilities. And for current assets and liabilities, you'll do what? You'll do the opposite. For gains and losses, which is L, is the remind you that you have gains and losses, you do what? You do the opposite. Now, for certain amortizations and depreciation, you will do what? You will always add the depreciation, which is like the easiest point in the world on the statement of cash flows. You always add depreciation and most amortizations. Okay, for example, if they're telling you there was amortization of an intangible asset, that's just like depreciation. We just use a different word, right? But you have to be careful if it's what? If it's bond premium amortization, okay, or bond discount amortization, okay. So if it's a discount, you will do what? You will add the discount amortization. You will do what? Subtract premium amortization. And I think that's worth adding to this flashcard. That's amortization and depreciation, and then CLAD, right, finishes off the mnemonic. But I really think that, you know, they were just trying to make it spell something. They didn't want to say claw. So I think they could have just said always add depreciation and it would have worked too. Amortization and always add depreciation. They could have put 2 A's in the CLAD. Anyway, deferred items, it's current items that you're analyzing, right? Anyway, so you analyze your deferred taxes, for example, as a current item, and that would also allow you to come up with cash provided by operating activities. Okay. Now, again, they use those same 2 statements that I showed you before, and they sit there and they show you how to prepare the statement of cash flows using those rules. And again, the major difference is going to be cash flow from operating activities. Investing in finance activities is the same regardless of whether you're using direct or the indirect. Okay. Now, just to quickly look at one thing here, this gain on the sale of the equipment. Okay, and you can see that the gain on the sale of equipment was $80, and then they start to show you some of the calculations. Okay, sometimes you will need to what? You will need to, they're showing you the gain from the sale of equipment. Okay, but don't forget that they may give you the equipment account and you're going to have to analyze the equipment account to find out maybe what the gain was. So they may not give it to you, or they may make you figure out the depreciation. So if they sit there and they tell you the beginning balance in the equipment, or they should give you a balance sheet and they give you the beginning balance, and then let's say they don't tell you what the depreciation was, well, they may give you the accumulated depreciation. Okay, and you take the beginning balance. The add is what? The add to accumulated depreciation is depreciation expense, isn't it? Isn't that what you add to your accumulated depreciation account? And then you would subtract what? You would subtract the accumulated depreciation for any asset sold. And then the question will give you what? Will give you the ending balance in the accumulated depreciation, whatever that would be. And so you would have to do what? You would have to use the blank account analysis format. Remember, beginning balance, add, subtract, ending balance. They'll give you, and for the accumulated depreciation for assets sold, it'll simply be the difference between what? Between the book value and what? Cash received for that asset. No, what am I saying? I'm getting into the gain here. It'll simply be what? The difference will be the original cost minus the book value. That difference is going to be what? The accumulated depreciation. So they may make you look for that number as opposed to just give it to you. Okay, it's the cost versus the book value must be the accumulated depreciation. So they may make you work a little bit for that. And then for the gain, if they don't tell you the gain, it would be what? It would be the difference between the book value, okay, that book value for equipment, gain on sale. If they didn't just give it to you, gain on sale, it would be what? The book value versus what? Gain or loss, I guess, could be gain or loss. Let me write that. The gain or loss is going to be the difference between what? Between the book value and the what? Cash received. If you receive more cash, it's a gain. If you receive less cash, it's a loss. And so you'd have to know to calculate that gain or loss, do the opposite for gains and losses, right, in the operating section. And then you have to remember to do what? The actual cash proceeds will go to what? Will go to the investing section. Okay, so, you know, preparing a statement of cash flow is kind of like trying to, you know, I don't know. I think I used to remember every now and then, I think a better thing is you get a knot in your shoe and you're trying to get that knot out and you have to kind of remember all these kind of intricacies. But if you sit there and you keep messing with it, eventually you kind of figure it out. Okay, but again, if there's something that's bothering you that you can't get to, move on. Don't sit there and keep trying to you know, force this thing to balance. You know, just because you're a good accountant, make sure you know, kind of keep in mind that you're taking a test and you're just trying to get points, and time is of the essence. Okay, question. Okay, good. Come over and investing activities, what goes in there. Okay, and for investing activities, I want you to just think of a investing department. Okay, so I don't think that you necessarily need to, you know, put a lot of flashcard on this, but just kind of have a visual. If you have an investing department in your company, what would you ask that investing department to do? Make investments, right? So you'd ask them to go out and buy stocks of other companies, bonds of other companies. You may ask them to invest in your own property, plant, equipment, right? Okay. Later on, if you sell some of those investments or you sell that property, plant, equipment, then that would be cash what? Coming in from that. Okay. Now, the only thing that is annoying about this, the indirect method, if you receive what? Dividends from those stocks, or you receive interest from those bond investments, the interest goes where? Operating section, which to me bugs the hell out of me, because I have to remember that. And the reason I have to remember that is because instead of starting with operating income and reconciling the cash provided by operations, which to me makes a hell of a lot more theoretical sense, because of the fascination that, you know, the users of financial statements that are not accountants have with net income, they have you start with net income and reconcile the cash provided by operations, which gets you stuck having to do what? Having to put interest received and dividends received, dividend and interest income, I should say, what up is reconciling items in the cash provided by operating activity. Whereas the proceeds on the sale goes where? Goes in the, you know, on the proceeds, say on the sale of an investment, goes where? Goes in the investing section. When you sell the equipment, that goes in the investing section, and then you're stuck doing that opposite for gains and losses. So that small thing of reconciling for net income instead of operating income is what creates some of the more confusing elements for the statement of cash flows for students in my mind. Okay. Okay, good. Now you come over and you look at the financing section. Okay, and again, there's an exercise. I'm not gonna go through that with you, but you should be able to go ahead and essentially do the whole statement of cash flows by analyzing that balance sheet and that income statement that we saw earlier. For financing activities, think of what? Think of a financing department. So what would you tell your financing department? You would tell your financing department, get me financing. Get me money to do what I want to do. So if you want to buy a piece of equipment, or you want to open up a new line of inventory, you would maybe borrow the money. So there'd be long-term financing. Maybe you borrow some money through bonds. You may issue stock, right? Okay, so that's the money coming in. And then of course you have to do what? You have to pay the principal back. Payment of principal would be a use of cash in the financing section. The interest goes where? Goes in the operating section. When you the cash interest that you have to pay would affect the operating section. The what? For the stocks, you get the stock, you do what? That goes as cash inflow from financing. If you buy back your own stock, treasury stock, that's a cash use in the financing section. If you pay dividends, because dividends don't affect net income, now what? Now paying dividends can reasonably be where it belongs, which is what? As a cash used in the financing activities. Okay. Question. Okay, good. Now that takes us through, and we don't necessarily need that summary, other than to point out a couple of items here. And notice here, guys, that if you purchase and sell trading securities, that goes into operating activity. So if it's a trading security, it does not go into investing. It goes into operating. And that makes sense, because think about it. Trading security is one that you're trading on a day-to-day basis, which means it's probably an operating type of situation. You're probably that kind of an entity, that a bank or something like that. Okay. Notice collecting interest on investments goes where? Operating, which I find annoying. Okay. All they'd have to do, FASB, if you're hearing me, if you're listening to me, is just have the reconciliation be from operating income to cash provided by operations, and we get rid of these annoying things which tell us collecting interest and collecting dividends on investments is an operating activity item, and then coming down, paying interest on debt is an operating activity element. So again, that gets a little annoying because to me, they feel like financing, they feel like investing, but because we're reconciling net income, we have to do this. Okay. Okay, good. Now you come down and they talk about comparison by section. Okay, so let's just look at how they prepared this statement of cash flows now, and they give us the differences, and this is going to be what? This is different from indirect. And that's the major difference from the indirect. I probably could have just said different because they're saying to us to indirect method. It's different from indirect because we are going to be showing these major line items in here, as opposed to what? As opposed to showing you a reconciliation from net income to cash provided by operations. Operating investing activities is what? Operating activities is the same, not operating, investing, excuse me. Financing is what? The same, there's no difference, okay. The what? The net increase or decrease in cash is the same, okay. It's not going to change, it's just how you formatted the information, right? Guys, you will see on the balance sheet the cash at the beginning of the year and the cash at the end of the year. They won't show you this. They will show you the cash at the beginning and the end of the year because they're going to give you two balance sheets and you have to compare them. That may not tie. You figured out what the net change in cash is, in this case, an increase. You add it to what you were told was the beginning, and then it gives you a different number from what you were told was the ending. Put what the balance sheet told you was the ending. That's an easy point. Don't sit there and say, oh, well, it has to add up, so I'm going to put whatever it added up to, thus intentionally putting down the wrong number. You know what the number is, right? So even though on its face, the statement of cash flow won't reconcile, put down the correct numbers. Don't put in wrong numbers, okay? And then you come down, and when we get into the direct method, is which we're talking about here, you still provide the reconciliation. Of net income to cash provided by operations. That's probably one of the major reasons that companies just go ahead and go with the indirect method, because they look and they're like, well, we're going to have to provide that anyway. It's same as the operating section, isn't it, of the indirect method. So maybe a lot of companies say the hell with it. Okay, I'm just going to go ahead and I'm going to just do the indirect method since I have to do that work anyway. Disclosure of accounting policy is going to be the same. Okay. Okay, and here are some additional things that are summary. I don't think you need to spend a lot of time with that because I think we have flashcarded the key elements. Okay. All right, good. Let's go ahead then, if there are no questions, and try a couple of questions that the statement of cash flows. You will definitely see some like this, multiple choice questions. You could be asked to do task-based simulation, and Becker does have a practice task-based simulation as part of your software for your homework for chapter 7. But let's go ahead and let's take a look at our first multiple choice question. And don't be surprised if I ask for some help on some of these. Okay, guys, 10 seconds. Okay, that's 3 minutes. That is longer than it should take you, okay, to do a question like this in the exam. I would say this one would be 2 minutes tops, maybe less than 2 minutes. The correct answer here is C, and most of us got it correct. And this question looks more complicated at first look than it actually is. I think you probably saw that as you went along, but let's go ahead and stop looking at that one. And who's Phoenix? Who is Phoenix? I'm sorry? I don't have a Phoenix on the roster. Who's Phoenix? I'm sorry?
Is it Phoenix Tucker?
Oh, okay. I see you. Okay. Thank you. So what did your name is near the top of the roster and it gets obscured by some other things. So they were asking us what was the cash balance at the end of the year. So if we're sitting there and we're talking about cash balance at the end of the year, we must have what? Had to have been given the beginning balance.
Yes, that was $27,000.
Okay, good, 27,000. And then they wanted to know the ending balance. Okay, so what elements did you look at to be able to get that?
So I added the operating activity, which was for $351,000.
Okay,
And
so you looked
then,
at the operating activity, right? Is that what you said?
yes,
So, and they said what cash provided. So we have to add that, right? Okay, good. What was the next one?
and then I added the financing activity for $250,000.
Okay, good. Financing. You know, I don't know that the examiners get too hopped up on the order, but it's probably worth noting that the most common way to prepare a statement of cash flows is to go operating always first, then investing, then financing. I don't know that the examiners are too worried about giving or taking points for an order for the financing and investing that is flipped. Always put the operating first. But just, you know, we're trying to squeeze every point we can out of this endeavor. So I would advise always, of course, it doesn't matter for multiple choice question, but for a task-based simulation, make sure you put investing first. When we look at the statement of cash flows for government, you actually put financing ahead of investing. And that's one of the things we'll talk about more when we get into the government discussion. Okay, I'm sorry, go ahead. And then you.
And then I subtracted the investing activity, the $420,000 from there.
Good, good, because they said cash used, right? Good. So
Yes.
for the investing, you subtracted that 420. Okay, good.
And then I got 208,000 as the ending balance.
Good, good, good work. Excellent. Okay, so then you notice, and that's common in some multiple choice questions. When you first look at it, you got that little, you know, you start getting palpitations. Take a deep breath, look again, and often it is just, you know, fairly straightforward. That's why I said you should have probably been able to work this in probably less than 2 minutes. I gave you 3. Okay, all right, good. Good work. Thanks, Phoenix. Okay, let's look at this one. Okay, good, guys. It's about 2 minutes now, which is about the amount of time it should take you to answer this question. Actually, not even that. It should take you really about, I don't know, maybe less than a minute, maybe 40 seconds to answer this question. Okay, but most of us got it right. There were some 3 of us that sort of went in a different direction. Okay, but let's just go ahead and look at the question. And they tell us that TAM company here recorded the following. What amount should we have as the supplemental disclosures in the statement of cash flows? So just taking a look at supplemental disclosures, and they're talking about what when you use the indirect method. Okay, so let's take a look at Leodin. What did you think should be included?
You say Leodon, Leodan?
Yeah, sorry, Leo.
No worries. Kind of hard to say for people.
What is it?
Leodon, just
Leodon.
combine Leo and Dan.
Yeah. Well, that's what I did. I said Leo D.
I'm just like,
Yeah.
yeah, I was looking back at the other pages and I remembered it was only counting the 325 from income taxes paid and then added the net interest payments.
Right. We
That was
have to show what the net interest payments, income taxes paid as a disclosure. In the direct method, we're putting it explicitly up in the operating section, right?
Yeah.
We don't have to do that in the indirect, but we do need to disclose it. Good. Excellent.
Oh, thanks.
Any question on that one? And so if you add the one, I should probably complete the thought. If you add those 2 together, right, that's how you get the 545, the correct answer. Any question? Okay, good. Good work, guys. I am going to go ahead. Don't leave. I'm going to take an early break here because I want to give you a chance to assemble the documents that you will want to be looking at for now our venture into governmental accounting. We're going to start in module 5 of chapter 8. The first part of chapter 8 is not for profit. I will go through that with you, but after we've gone through governmental. Becker has flipped that. And I think that's a mistake because they used to have governmental first, and there are things that we can learn about not-for-profit through analogy of not-for-profit. So I'm going to go back to the past, the way they used to do it, and we're going to talk governmental first. Plus, governmental is easily 15 to 20 points on the exam. And not that I like the Facebook FAR group, but that's the biggest whine I see on the Facebook FAR group. No one ever told me that governmental was so heavy. Well, I'm telling you now, governmental will make the difference between you passing and failing the exam. So I'm going to make sure that we get a good coverage of that. Not-for-profit is also important, but governmental has become much more important than not-for-profit in the last years as they changed the format of the exam. So we're going to go through the governmental stuff. We'll come back to the not-for-profit. Now in e-learning, and I'm just going to go ahead and put my e-learning in student view. I'll show you, I wanted to show you now. Really? Okay. Well, it's not going to let me do it. Let me see. Maybe if I do it this way. Let me close this and let me come back. To my GGU. Yeah, I think I could do it that way. Come on. Come on. Okay. And e-learning. Switch role to student. Okay. And this is how it looks to you. And so when you come down to chapter 8, you see that I've got a few supplemental things. I think the one I want you to open in the non-exchange revenue is this one, because it just has the one slide in it, and we're just going to be using the one slide. I put some other supplemental slides there, but that second one, please open that, okay? Because we're going to go through and look at that. And then going back to e-learning. The other ones you should open is this inventory example, and you should open, that's it, just those two. We're going to use those two here tonight, and of course the textbook. These other things are supplemental to help you to further understand some things, but we're not going to go through those tonight. Okay. Okay, so get into chapter 8, module 5, find your book page there, find the inventory example, find that non-exchange revenue example that just has the one slide. I'm going to go ahead and give you a little extra time since you're going to be pulling those documents together. So let's reconvene at 6:10. We'll take about a 13-minute break, okay? Okay, guys, I'll see you in a few minutes. I'm going to resume the recording, and we are going to jump in, and we're going to take a look starting with chapter 8, module 5. The first 4 modules are not-for-profit accounting. We will come back to that, but I want us to get into governmental. Again, governmental, as I was saying before the break, 15 to 20 points on the exam. There is no way to pass the FAR exam without having a good understanding of governmental accounting. Golden Gate used to have a governmental accounting class on the catalog under my somewhat moderate protest. They went ahead and removed that from the catalog, and the reason I was protesting is that it is important for the CPA exam. Having said that, I believe that we spend some time with this, you're going to find that governmental accounting is actually going to be an ally and going to be a strong point for you on the exam, because once you get used to some things that are a little bit different, a little bit weird about governmental, this becomes a relatively easy 15 to 20 points. I can't think of another part of the exam where just a little bit of due diligence to understand some requisite things yield you this many points. Okay, so this will actually be a strong point for you on the exam versus what other candidates are, complaining and saying is that they don't feel that they really understand governmental. I'm also going to give a shout out to the person that puts this material together for Becker. His name is Tom Cox. I've worked with him directly dealing with government continuing professional education classes. We really started that, he and I working together, started that for Becker. They have a full catalog of governmental accounting classes. Now I'm really no longer involved in teaching or recording those. I'm still on the video for some of those though. Tom would write the course, I would deliver it. Tom does an outstanding job. This is the best academic material for governmental accounting I think that is out there. And I've looked at a lot of governmental accounting books over the years. So, okay. So let's go ahead and let's take a look at some of the key things that we're going to be talking about here. And let's just look at the objectives of fund accounting. Okay, we're going to be learning something about fund accounting. And you can see that it enables service driven organizations, which the government is, to easily monitor and report compliance with spending purpose. Okay. And when we talk about compliance with spending purpose, compliance could really also be stated as what? Compliance with legal restrictions. So if the law says that we can only spend $1 million on a particular activity, fund accounting will allow us to determine whether we're meeting that compliance, we're in compliance with that legal restriction to only spend $1 million on certain purposes. Okay. Now, they also talk about spending limits and budgets. Okay, so again, compliance says we can only spend the money on a particular purpose. Budgets would be what would be the $1 million, right? So we will also want to achieve financial control. So if it says we can only spend the money for road improvement, that's the legal restriction, the compliance restriction. Spending limits, the budget, achieve financial control. And we will also want to achieve in another area that we really will be getting into here is what is budgetary control. Okay, so why don't you go ahead and sort of flashcard these big kind of objectives, which are what? Compliance with legal restrictions, achieving financial control, achieving budgetary control. Those are the objectives of fund accounting that we'll be talking about quite a bit here for the rest of the evening. Okay, okay, good. Now you come over and let's just sort of use a I don't know, kind of a visual here. This is where we get to see how good my artistic ability is. Okay, so what is this? Anybody want to guess?
Road.
It's a road. Very good. See what an artistic genius I am? You didn't even have to think about that much, right? Okay, so this is a road. Good. And what happens? Let's say we put a tax on gas. So we have a gas tax. And of course, guys, I can't help but, I don't know, I should be able to help it, but I don't want to help it. You know, Biden wants to suspend the federal gas tax right now because the price of tax is going up, and is being blocked from doing that by the Republicans, who are always saying taxes are out of hand. Okay, so why is that happening? Unless it's just pure politics. Okay, then stop. I'll stop there. Okay, but anyway, what happens? We put a tax on gasoline. Okay, and we say that gasoline should only be used for road improvement. And we say that we can't spend more than $1 million in a year. Well, we would establish a fund, and we're going to see that that fund is called a special revenue fund. And that fund whole job would be to make sure that we do what? That we only spend the money on road improvement, and we spend it on what? We spend it on road improvement, and we don't spend more than what? More than $1 million. That's what funds do. Okay. Okay, we're going to talk more about that, as I said, as we go along. I probably should have started with that. I just forgot to start with that. Now, when we are looking at governmental accounting, there are various governmental units at different levels, little civics here. We have what? We have the federal government, state government, county, and municipal, and a variety of other local governments, such as townships and special districts such as school districts and whatnot. Now, I'm going to cross out the federal government, not because I'm one of those, you know, January 6th guys, but what I want to do is I'm going to go ahead and say not on CPA exam. Okay, federal government accounting is a very specialized type of accounting. that the standards are promulgated by the Federal Accounting Standards Advisory Board, FASAB, and that is not tested on the CPA exam. So when we're on the CPA exam, it is going to be state and local governments. But rarely you might see a couple questions. They never say Mississippi did this or California did that. They'll just say state did this. But usually, because that's a little annoying, because then people start thinking, well, what state is it? They really have fictional cities and fictional counties. So it's really a city and county level discussion. Okay, that's what's tested on the CPA exam, 15 to 20 points. Okay, now the entity that sets the accounting standards is the Governmental Accounting Standards Board. It is the sister brother agency of FASB. They literally are both under the Financial Accounting Foundation. The Financial Accounting Foundation is the entity that gets the funding for the FASB and the GASB, and they both sit in the same building there in Connecticut. And you can flashcard that what? The GASB standards are the most authoritative. So that's what you follow when you prepare a set of governmental financial statements. So if you're the city of Hayward, you follow the GASB standards when you set your account, when you prepare your financial statements. If you're the city of San Francisco, you follow the GASB. If you're the county of Alameda, you follow the GASB standards. If you're the state of California, although the CPA exam will never call out in the state of California this happened, but if you're the state of California, you follow the GASB standards. Now, when you come over and you look at this chart on the next page, okay, they talk about GASB and how GASB tells us what goes into the financial statements and any information that is necessary to supplement the financial statements. But when you pick up a government's financial report, it is usually enclosed in something called a comprehensive annual financial report. Those standards are promulgated by an entity called the GFOA, the Government Finance Officers Association. And when we look at some of the budgetary requirements for the annual report and whatnot, we're really following GFOA. So when it comes to the financial statements, yeah, you're going to follow GASB. But if it comes to the annual report, now all of a sudden the GFOA weighs in and says, well, we want you to prepare an MD&A to go along with the financial statements. We want you to provide a hierarchy, an organization chart of the government. Well, those kind of things are talked about by the GFOA in the Comprehensive Annual Financial Report. So it's really, you know, how SEC tells companies what they should put in their 10K. Well, the GFOA is the organization, although it's not a government entity, it's a consortium of government finance officers. They basically tell state and local governments what they should be putting in addition to the financial statements in their annual report. Now, sometimes students will say, well, why would they follow that if they're not an authoritative source? Well, what they do is they give an award for excellence in financial reporting to state and local governments. And if you follow what they ask you to do for your comprehensive annual financial report, you can get this excellence award. And one time I had a student that said to me, well, I wouldn't care I wouldn't care if I got the excellence award. I'm like, yeah, right. You get hired as the chief financial officer of the city and county of San Francisco, which has received that award for many, many years now. And then all of a sudden, when you take over, you're not going to get it anymore. Yeah, right. I mean, it's probably going to be written in your executive contract that you will achieve that. So most state and local governments follow that. Okay. Okay, but most of the reporting that we're going to be looking at is going to fall right here, but we will be understanding something about this probably more in F10 as we move along. Okay, okay, good. Now we come over and we take a look at some of this sort of principles discussion, guys, and I'm not going to spend a lot of time with this. If you see any questions about things like consistency, comparability, that sort of thing, you know, you can go ahead and, you know, make a flashcard of what the key concept is there and move on. There's nothing really other than very high theoretical things. And this picture does nothing but scare me because I'm afraid of rodents, and I've got mice in my attic that are driving me nuts. So I don't even want to look at that very long. So let's go ahead and let's move on. And if you see some of those questions that deal with those mice or whatever, just go ahead and make a couple flashcards and you should be in good shape. That stuff's not very heavy on the exam at all. Okay, now let's go ahead and let's take a look, and they talk about external reporting. Okay, and here they tell us that GASB establishes the reporting requirements to be in compliance with GAAP. Okay, reporting requirements include both fund-based and government-wide financial statement presentation, and then of course those are supported by the notes and then some of that supplemental information. So we saw that on the chart, right? Okay, but let's go ahead and let's just take a look at how that will look for us as we go through and we start to take a look at some of this. Okay, so you don't have to write this down if you don't want to. Okay, you can just sort of watch what I'm doing here. Okay, so what will happen is when you pick up, say, the City of Hayward's financial reports, you will see fund, not fund, but fund financial statements. And we're going to talk about the names of these fund financial statements here in a little while. Okay, and you will see that there will be three categories. There'll be governmental funds, there'll be proprietary funds, and there'll be fiduciary funds. Okay, and there are 5 governmental funds that we're going to learn the names of, which give you a lot of easy points on the exam. There are 2 proprietary funds, and there are 4 fiduciary funds. Okay, so when you look at that, it's what? It's 3 categories and 11 fund types. Okay, and we're going to get more into that later. Now, if you look back up here, that was the fund financial statements, right? They said they show both fund financial statements and government-wide. Okay, so government-wide, financial statements are a consolidation of the fund statements. So what they do is they take some of these funds and they consolidate them, and I probably need to adjust my circle here, and include them. Bastard. 2, 3, 4, 5, 1, 2. Okay, and what they do is they consolidate them, and they consolidate them either under governmental activities or business activities. And we'll talk more about this really in chapter 10. Okay. Okay, so what happens? The government-wide statements are a consolidation of the fund statements. So think of it this way. You know how you pick up a consolidation and it's the consolidation of all companies under one ownership, and they don't necessarily show you the details of company A and B, right? in a consolidation, just see the consolidation of however many companies are under that single ownership. In governmental accounting, we show you both levels. We show you the disaggregated, unconsolidated level. We show you what? We show you the consolidated level. Okay. And so we're going to be talking more about the government-wide in F10. Of those 15 to 20 points, that's maybe 5 points. Okay. In F8 and F9 here, this is where we're really going to be spending most of our time, because what? That's probably about 15 of those 20 points, and they don't spend too much time on the government-wide. Okay. Question. Okay, that's just a little look forward as to where we're going, but let's go ahead and see how we can do this first question on governmental accounting. Okay, guys, let's go ahead and take a look at this one. Looks like everyone's had a chance to. We're about a minute and a half, probably take you 30 seconds to answer that one, right? Because we had on our flashcard that what? Yeah, one of the objectives is financial control. The other is what? Legal restrictions. We also called out what? Budgetary control as an objective as well. Okay. All right, good. Is Andrew here? Andrew? How about Big Den Lee? Okay. Okay, good. So let's go ahead then and let's go on and take a look at the next area here coming down, which is going to be the fund structure. Now, we kind of already know this, in that we said that we have what? We have 3 categories of funds: the governmental funds, the proprietary funds, and the fiduciary funds. And then we have what? 11 funds that fall under those headings. We kind of already said that. Okay, but you can see that there in the textbook. Now, when we talk about the governmental funds, okay, and governmental funds, okay, use modified accrual basis of accounting and the current financial resources measurement focus. Now, what's going to happen here? You are going to have to understand some key differences between accrual accounting and full accrual, modified accrual accounting and full accrual accounting. You're going to have to understand some key differences. Okay. Now, what happens? Remember when you were 2 and you decided that you wanted to be an accountant? Do you remember that? Okay. You were probably playing somewhere in the park with your mom and you were having fun, and you saw somebody all stressed out heading off to work, and you said, "Oh, what does that person do? That looks like so much fun." And your mom said, "That's an accountant." You said, "Oh, that's what I want to do when I grow up." Remember that? Okay. And so your mom said, okay, but you have to always promise to use full accrual accounting. Okay, now what's full accrual accounting? You said, what's full accrual accounting, mommy? And she said, well, she pulled out that little whiteboard she kept with her at all times. And she says that what? Full accrual accounting, if you purchase a piece of equipment, you have to always promise that you'll debit an asset account called equipment. And if you paid cash for it, you'll credit cash. He said, oh, mommy, I promise I'll always do that, right? Okay. Now what happens? That's full accrual, okay? Under modified accrual and the current financial resources measurement focus, now what happens? Well, now we say that, you don't necessarily have to use full accrual. So if you purchase, say, a steamroller, what's a steamroller? It's a tractor with a big round wheel on the front of it that flattens the roadbed. Right after you wash your car, you run into one of those, right? That throws all this dust and everything all over. It's a piece of equipment, right? And let's say we're using that for what? For road improvement. We'll go back to that gas tax and the special revenue fund. At that point, when we spend that money, we have met our accounting objective. We spent it for what? We spent it for road improvement, didn't we? So there's no capital maintenance requirement for the governmental funds under modified accrual accounting. So we would literally debit expenditure for that and say we paid $1,000 for it. We would debit expenditure, we would credit cash. We don't have to debit equipment like you promised your mom you would always do, because we have met our accounting objective. All we had to prove was that we spent the money for the specific purpose, right? And that we've spent it within legal restrictions and within budgetary control and whatnot, right? Okay, so there are a handful of differences between governmental and not-for-profit that you're going to have to get down. That gives you 15, 20 points. And once you get those things down and practice with them enough, those will be easy 15, 20 points. Okay, question. Okay, good. Now, what are these governmental funds that use this modified accrual accounting? Okay, and the governmental funds, we've already said there are 5 governmental fund types. Okay, although there's only one general fund, put a G there for general fund. There could be several special revenue funds, put an R there. And guys, don't worry, you're like, well, what do these funds do? We're going to talk more about this as we go along. Okay, so don't worry about that right now. There is several, probably, there's actually only one debt service fund. There could be several capital project funds. There could be several permanent funds. So that's why we call them fund types, although there's only one general fund and one debt service fund generally. But notice we're giving you a mnemonic for remembering these, which is what? GRASP. Okay, those are the governmental funds. What type of accounting do they use? Modified accrual. What's the measurement focus? Current financial resources measurement focus. I just gave you information that'll probably answer about 4 questions on your exam right there. Just remembering what the fund types are. They are governmental, and knowing that they use modified accrual, current financial resources measurement focus. Okay. Now you come over to the next page, and all governmental funds prepared 2 financial statements. They have a balance sheet, and they have something called a statement of revenues, expenditures, and changes in fund balance, which is like an income statement. IS is income statement. Okay. Now, when we look at the balance sheet, I want you to flashcard the format. Okay. Now, you know that what? Assets. Let's see. If I prepare a balance sheet for governmental, I'm going to show what? I'm going to show assets. They'll all be listed, and then I'll report what? total assets. Let's say my total assets are 100. Then I'll report what? Liabilities. And my liabilities will be what? My liabilities will be, say, and I'm just making this up, guys, will be, say, 40. And then what? And then my stockholders' equity would obviously be, now I'm going to end up with blue on blue, so let me turn that to red, would be 60. And then I would report what? Total assets and liabilities. I mean, total liabilities and stockholders' equity. Not doing a very good job here. Total liabilities plus stockholders' equity. And that would total to 100. So the balance sheet would balance, right? Well, when we look at the balance sheet for governmental, they take, and it's current assets only. It's current liabilities only. We do not show long-term assets, long-term liabilities on the governmental fund balance sheet. Again, this is for all the funds: general fund, special revenue fund, debt service fund, capital project fund, permanent fund. Those 5 funds in the government that make up the governmental fund category only report current assets and current liabilities. And think about it. They're using, under modified accrual, current financial resources measurement focus. If they spend money on a long-term item like equipment, they treat it as expenditure, didn't they? So there would be no current assets, non-current assets, right? When we bought equipment, we debited expenditure, didn't we? We didn't debit an asset account. Then fund balance is like, and sometimes they'll say, well, it's like stockholders' equity, but it's really like what? Like retained earnings, because governments don't sell stock. They don't have common stock. They don't have additional paid-in capital in excess of par or any of that kind of thing. I mean, I don't know. Trump probably wanted to sell stock to the U.S. to you know, some foreign countries or something. But for the most part, what we sit there and we just have the retained earnings for government. And then just like you saw up here, we do what? We total our what? We total our liabilities and our fund balance, just like we saw up here. Okay. Now, up here, we also have deferred inflows and deferred outflows. Deferred outflows, just put down here, are like prepaids, but not quite. And we're going to talk more about those a little bit later tonight. Deferred inflows are like deferred revenue, but not quite. And we're going to see what constitutes something being a deferred inflow, deferred outflow versus a current liability fund balance. But we show, I mean, current liability, current asset, we show them next to the current assets, since the prepaids are like deferred, since the deferred outflows are like prepaids. We show the deferred inflow next to the current liability, since they're like deferred revenue, but they're different. Okay, we're going to see how that will work as we go along. Okay, now we come over and we look at the, so I want you to flashcard the format here, and I want you to put down that this is a required format. This is the required format for the balance sheet. And I want you to flashcard it just like that. In fact, what you should do is just copy this page out of your book and put it into a flashcard. It's already kind of flashcard size, isn't it? So just copy this page out of your book and make a flashcard out of it. Okay. Now, when we look at our statement of revenues, expenditures, and change in fund balance, which is like our income statement, I want you to flashcard the format for this. which is we have revenues minus expenditures. Okay. Now, when you look at the revenues minus expenditures, that basically gives us what? Assuming we have a positive, an excess of revenue over expenditures. That's what they call it. That is like what? Operating income. That says like operating income. Just listen to what I'm saying. Don't try to read it. It says like operating income. That says like operating income, but we don't call it that. We call it excess of revenue over expenditures. Governmental accounting is a little wordy. Okay. And then we have what? We have other financing sources. Okay. Other financing sources are like L-I-K-E, non-operating revenue. Other financing uses, let me turn that to blue. Other financing uses are like non-operating expenses. Okay. The net change in fund balance is what? Is like net income. Okay. So let me ask Angel a question. So Angel, if other financing sources are like non-operating revenue and change in fund balance is like net income, would other financing sources increase fund balance or decrease it? Angel? Angel?
Yeah.
You want me
Can
to
you hear me?
repeat it? Huh?
Yes, please.
Yeah, if other financing sources are like non-operating revenue and fund balances like retained earnings and change in fund balances like net income, would other financing sources increase fund balance or decrease it? Go ahead.
Increase it.
Good, excellent, right. It would increase it because what? Fund balance is like retained earnings, right? And revenues increase retained earnings, don't they?
Yes.
Increase net income, they increase retained earnings. Good, excellent. Very good. How about Casey, what do you think about other financing uses? If they're like non-operating expenses, would they increase or decrease the change in fund balance?
You said other financing uses,
Yeah, other financing uses.
if they're like non-operating expenses,
Mhm. Would they increase or decrease fund balance?
decrease.
Good, excellent, excellent. Okay, good, very good, guys. Okay, so I want you to flashcard this, and one of the things you're going to have to start getting used to is how, and I think with revenues and expenditures, it's pretty straightforward. But with other financing sources and uses, because that's not a term we're used to, you want to make sure you understand how those in fact affect fund balance. Okay, question. Okay, good. Now you come over and we take a look at our proprietary funds. And there are two proprietary funds, okay? There is the internal service fund and the enterprise fund. Now they are building a mnemonic here, so you can go ahead and fill in these bubbles, which is not I, but S, I should say, and E. Okay, they're building a mnemonic, and I'm going to show you where the full mnemonic is here later. But those two funds are like business type activities going on in the government. They use full accrual accounting economic resources. Well, those are going to be easy for us because you've been using full accrual accounting since you were 2, right? You promised your mom you would. If you purchase an asset, you debit equipment, you credit cash, whatever. Okay. Example of an internal service fund is a motor pool. So what happens? The customers are primarily internal to the government. So do cities own vehicles? Let's hope you don't have one behind you on Friday night when you're coming home a little bit late, right? Okay, police car is a city-owned vehicle, right? Now what happens? We don't want to take our police cars, our fire trucks, which are emergency type vehicles, to Al's garage to be worked on. We want them to be maintained at high safety specifications, right? So what do? We create a central motor pool. That central motor pool charges the fund that is responsible for that asset, in this case, that's being repaired, say the police department, or they'll charge the general fund, which is where police is usually accounted for. They will charge the general fund for that service. The general fund will debit expenditure, credit cash. The internal service fund will do what? Debit cash and credit revenue. So since it's like a business, it follows what? Full accrual accounting, okay? Enterprise fund will have a different requirement, okay? Classic example of an enterprise fund is water utilities, sewer, utilities like water and sewer, for example. Do cities use water? Yeah. Do people outside of the government use water? Yes, you're outside the government, you're getting ready to go out on a Friday night, you want to look good, so you wash your hair. What happens? You get all kinds of soap in your hair, and then all of a sudden they cut off the water on you. And you say, help, turn the water back on, I got soap in my eyes. You have this problem, I don't, okay? So what happens? You're sitting there, and the water utility says, well, pay the bill. So they're going to bill you for that service, aren't they? And they have to do that because they need your fees to run that water utility, okay? So what happens? When that's the case, then it would be accounted for as an enterprise fund. So enterprise funds are required when any of the 3 criteria are met, okay? The activity is financed by debt secured by a pledge of fee revenue. Would you buy a water bond? Guys, there is from an enterprise fund, there is unlimited revenue that you know is coming from a water utility because people need water to live. In fact, it's arguable that they should even be allowed to set up an entity that you have to pay for water, but the realization is that unless somebody pays for that water, it won't be able to come because they have to build all kinds of resources, lift stations and everything else to get the water from the Hetch Hetchy Reservoir to come out of your faucet in San Francisco, to come out of my faucet in Hayward, okay? And so what happens? You will charge for that service, but sometimes they'll issue a debt, and then the debt will be paid back from what? From fee revenue. Or the law requires the collection of what? Fees to recover costs, or pricing policies are established to what? To produce fees to cover costs. Do you see the key word here, the theme? If what? If fees are involved for the use of this, then it is what? Considered an enterprise fund, whether it's to repay debt or to cover costs. Okay, so flashcard, that about enterprise funds. Internal service funds, the customers are what? Are internal. For the what? For the enterprise fund, most of the company, customers are external, for example, the citizens. Okay, and it's all about what? It's all about user charges at the end of the day. Okay, good. So let's look at their financial statements. Okay, and again, it's two. There's a balance sheet and an income statement. Actually, there's three for these guys. They also prepare, although not pictured here, but you might as well start to think about it a little bit. They also prepare what's SCF, statement of cash flows. Okay, even though they didn't show it here. Okay, but we'll worry about the format of statement of cash flows much later. Okay, but notice, guys, since it's full accrual, all assets, all liabilities, both current and non-current. For the governmental funds, it was just what? Current. Here it's current and non-current. But notice what they do. They take what I call the difference approach, which is what? Assets, say, are 100, minus liabilities. I'm not going to put that line there. Get rid of that line because that's confusing. Minus liabilities, which are, say, what? 40. Gives me now what? If this was sort of a commercial approach, stockholders' equity of 60 is the way we would show that. Well, that's what they're doing here. They're saying, hey, look, you don't have to gross back up the liabilities plus the equity section like we did in the required format for the governmental funds. Okay, you can just show that difference. So if my assets were 100, again, I'm getting into the blue on blue, my liabilities were 40, then my net position would be what? 60. Net position is what? Is like retained earnings, but we call it net position. Deferred outflows and deferred inflows, guys, same rule applies. Deferred outflows are like prepaids, but not quite. Deferred inflows are like deferred revenue, but not quite. Okay. This is the suggested format. Okay, that's the suggested format. So flashcard, what the statement of net position will look like, and that's for both of our proprietary funds, the internal service fund and the enterprise fund. There are GASB suggests that they use this format in which they're not grossing back up the liabilities plus the net position like we saw for the governmental funds, which are required to do that. Okay, now for the when you look at the title of the thing, it's kind of saying that to you. For the governmental funds, they called it a balance sheet, so we needed to show that it balanced. The focus here is what? What's left of the net position. So they call it what? Statement of net position. Okay. Now, when you look at our like income statement, okay, this is obviously like the balance sheet, like BS balance sheet. This is like the income statement. We have operating revenue minus operating expenses. Then we have non-operating revenues. We have non-operating expenses. Does this sound familiar? This is F1, isn't it? This is F1. Then we have what? We have change in net position. Change in net position is like net income, isn't it? And you will report right here what? That says operating income. Okay, so just like they're doing here, they're reporting operating income, just like we would, I should say, in F1. Okay. Question? And then there's a statement of cash flow. Don't worry about the format for that now. Okay, now fiduciary funds. Okay, there are 4 of those to total up our 11. 5 governmental plus 2 proprietary is 7 plus 4 fiduciary funds gives me 11. They also use full accrual accounting, economic resources, measurement focus. There are 4 of those: custodial funds, investment trust fund, private purpose trust fund, and POE, KIPPO. I don't know. I'm just going to have you remember KIP going forward, but for now, just go ahead and fill in those little bubbles here. Okay, CIPP is another way of doing this. Okay, but there are 4 fiduciary funds. They use full accrual accounting. Okay, but think about it. Let's just look at pension. Do you want someone to use full accrual accounting to keep track of your pension assets? I know I do. And so that's why for those funds, they say, okay, you will use full accrual accounting, economic resources. Now, when we look at their financial statements, okay, the statement of fiduciary net position is like the balance sheet. The statement of changes in fiduciary net position is like the income statement. Okay, I want you to flashcard these formats. Okay, and for the statement of fiduciary net position, this is the required format. Okay, and notice, guys, they're also using the difference approach. Assets minus liabilities equal net position. Okay, and then when we get to the like income statement of changes in fiduciary net position, additions are like revenues. And deductions are like expenses. And the change in net position is what? Like net income. Okay, now, very important, and I'm going to repeat this a couple of times because it's very important. Okay, and the deferred inflows and outflows are just note that they're reported. Deferred outflows next to assets, deferred liabilities next to, deferred inflows next to liabilities. Now, very important, guys, very important, very important. You could see a question in which they'll say to you, what type of accounting should be used on a statement of revenues, expenditures, and change in fund balance? Answer is what? Modified accrual accounting, because that's the name of the statement that's prepared by the governmental funds. They might say what type of accounting should be used on a statement of changes in fiduciary net position. And the answer is what? Full accrual, because that is the name of the income statement that is used for the fiduciary funds. Fiduciary funds use what? Use full accrual accounting. Sometimes I'll get a question from a student that say, well, they didn't tell me the fund. Yes, they did. They told you the fund by calling out the name of the financial statement, right? If they said, what should be reported on a governmental balance sheet, answer is what? Modified accrual, because only the governmental funds call it a balance sheet. The other ones call it what? Statement of net position and statement of fiduciary net position. Okay, and I'll be reminding you that as you go along, but that's an exam, sleight of hand that they use to mess you up on questions. Okay, good. Now, come over and let's take a look at, and I want you to go over to page 55 for a second. I'm going to come back to this, but I want you to come back to page 55. Come over, I shouldn't say back, but come over to page 55. And here's a couple of flashcards. Notice we went through that whole discussion of modified accrual and the mnemonic and which funds use modified accrual, and I didn't have you make the flashcard. The reason being that I want you to flashcard it here. Just go and copy this. and then make a flashcard out of it for yourself because it gives me everything I need to know. Modified accrual, current financial resources, measurement focus. There's the mnemonic. There's the funds that use that. Okay. Then when you come down and we talk about the economic resources and the full accrual accounting, which is basically just accrual accounting, they do what? They show you that it is the what? It is the proprietary funds and the fiduciary funds, and then they give you the mnemonic and they call out the funds. Okay, 2 very helpful flashcards right there, guys. You make those 2 flashcards, we're talking 4 or 5 multiple choice questions, easily correct in 30 seconds. Okay. And sometimes I'll have students say, no way, they don't ask a question that easy. Yes, they do. Okay. They just want to see, did you scratch the surface? Did you show up on a Thursday night? What's tonight? Tuesday night, when you could have been watching Tuesday Night Wrestling. Instead, you came and you sat here and you went through this. That's all they want to know about this, some of this stuff. Okay. Okay, good. Now, let's see what happens when we are talking about the current financial resource. Come back up, guys. I went back up to page 54. Current financial resources measurement focus used by the governmental funds, general fund, special revenue fund. A is and, so it spells grasp, okay? Permanent fund and the private purpose permanent fund and the capital project fund are what those 2 P's stand for. I had, when I first started teaching Becker, originally Becker hired me to teach governmental. And so I was teaching the governmental and I just started out and I was hired by an old guy. He seemed old at that time. Now I realize he's younger than he was younger than I am now when he hired me. But anyway, he's no longer with us. He's teaching CPA review, the big CPA review in the sky now, but Ed Cordisco. And Ed calls me or sends me an email. He says, I think you'd get a kick out of this email, John. He was a guy from Pittsburgh, so you talk like this, John. I think you'll get a kick out of this email. He sends me this email, and the student was complaining because I never explained what the A fund was here. A stands for what? Stands for and they were just trying to make it spell grasp. Okay, so there is no A fund in the governmental category, right? It's general fund, special revenue fund, debt service fund, capital project fund, permanent fund. Okay, now what happens? We come over here and under the current financial resources measurement focus, and we already know this, no fixed assets, no non-current liabilities, no non-current, it's current items only, right? Okay, now you come over, and if we're talking about what? The economic resources, full accrual accounting, and by the way, government-wide statements, which we're not going to talk about until later, also use full accrual accounting. So yes, now we will report what? Fixed assets and non-current liabilities. Okay, so again, your job is to understand the handful of differences between modified accrual and full accrual. That's a major part of your job. And if you do that, we're talking about a lot of easy points on the exam for you. Okay, now let's take a look at how modified accrual will affect the income statement. Okay, and again, it's used by the GRAS funds, but now we're saying, well, how will it affect the income statement? Really, we're focusing more on the balance sheet before, right? For income statement purposes, okay, under modified accrual basis, revenue is recognized when measurable and available. Okay, now measurable means that it is quantifiable in monetary terms. We know the amount. Okay, and you say, well, how would you not know the amount? Well, you may not know the amount if you're going to have to wait for somebody to file a return to tell you what your income should be. What do we call that return? In many cases, an income tax return. The government doesn't know how much money you owe them until you do what? until you file a return that says this is what you owe. Now, they may be collecting those income taxes as they go along, but they don't know the final determination until what? Until a return is filed. So it would have to be what? Measurable. Now you say, so you mean governments don't recognize revenue the whole time they're collecting it? No, they do. But by the time they get to their financial reporting, they have to estimate what refunds will be to then go ahead and report what they think their final revenue number will be, because what they know that some folks are going to ask for a refund. So if their reporting year was December 31st, the tax returns for that year, say December 31st, 2022, but tax returns aren't going to be filed until what? Until April 2023. So the government would have to adjust whatever they've collected during 2022 for what they estimate the refunds to be. How do they know what their refunds are? Historical data. Just like when you're trying to estimate your uncollectible receivables, right? You have data that tells you about what the level refund is. They adjust their revenue number for that. Okay, so that's just reminding governments, just don't put what you've collected. You have to kind of figure out what you might have to do for refunds. Okay, the one that is tested more on the exam is available. Okay, and under modified accrual basis, revenue is collected soon enough to be available to pay bills of the current period. That's generally 60 days. Okay, now I get a little upset at the CPA exam because they kind of sit there and want you to like memorize this 60-day criteria. Meanwhile, in practice, the standards do not say 60 days. The standard says it is available if it'll be available to finance expenditures of the current period, which extends to 60 days beyond the balance. It doesn't say that it extends beyond 60 days. The CPA exam kind of assumes that in some cases, but this standard doesn't call out 60 days. And there are some entities that would use 30 days as a threshold. Some entities would use 90 days. Some entities may use 120 days out and still call it available. Okay, so you kind of have to memorize the 60 days with a little bit of a footnote to be careful. Read the question carefully to make sure they're, making it clear that they're either assuming the 60 days, or maybe they're going to try to screw you and make it another number of days. But that one, they'd probably have to call out explicitly if they wanted to use 90 days or 30 days. Okay, I don't like the way the exam does that, but we got to live with it. Okay, now that's under modified accrual. Now, their expenditures now are generally recorded when the fund liability is incurred, with some exceptions, most notably debt service expenditures, which are not recognized until either due or paid. Okay, so what does that mean? Let's say the city of Hayward issues some bonds, and the bond amount, the bond is issued for $937,253. The interest rate is 4.23% on that, and interest is payable January 1st of each year. And Hayward issues those bonds on January 1st of year 0, and they're preparing their financial statements at December 31st, year 0. How much interest payable should Hayward record at December 31st? Answer is 0, because that interest is not due until what? January 1st of the next year. So you don't accrue interest in between interest payment dates under modified accrual accounting. So that takes you how long to answer on the exam? 15 seconds. Meanwhile, somebody else is dealing with all those funky numbers, the 423,000, whatever I said, the 4.23 interest rate, whatever it was I said. Okay, so when you're dealing with interest, you wait to record the interest expenditure when it is what? Either paid or legally due. And if we're not supposed to pay until January 1st of the next year, at December 31st, the answer would be what? 0. Question? Okay, so flashcard that's an important thing to flashcard. Okay, and flashcard, what we mean by available, but be careful with that 60 days. Okay. Okay, good. Now with full accrual, revenue is recognized when earned and expenses are recognized when incurred. Now you look at that and you think, oh boy, that's easy. And it's not as easy as it sounds, guys, because for the maybe for the proprietary funds, but for the government wide, because remember the government wide includes the governmental funds, and the governmental funds, we're going to have to go through some gyrations here to understand the categories of revenue and see what the rules are for the categories of revenue. But we'll get to that here in a little while. Okay, good. There's that flashcard for you that we've already said we want to make. And then they kind of summarize it again there, but I wouldn't worry about it. Just make it out of that other flashcard that I asked you to make. And then let's go ahead and see if we can answer a couple questions. Okay, guys, we're about at 1:30, and it looks like everybody has taken a shot at this one. Okay, I'm a little disappointed that we are at 73%. We had about 3 folks miss this one, and I'm looking, and I saw some answers came in like in 30 seconds, which is about how long this question should take you. The correct answer is C. Okay, but let's just look at this one. And maybe it's because you haven't had a chance yet to memorize, let me share the results. About 73% of us got it right. But maybe it's because you haven't had a chance to memorize the information here yet. But economic resources, accrual basis of accounting is used by what? Is used by the proprietary funds and the fiduciary funds. Proprietary funds are what? Are SEC, SE, the internal service fund, the enterprise fund, right? So the answer here is what? The internal service fund. You look at these others and you could, work at the inverse, which is what? Modified accrual, current financial resources measurement focus is used by what? The GRAS funds, which are the rest of these that are listed, general fund. They don't list the special revenue fund or debt service fund, but they do list the permanent fund and the capital project fund, the 2 Ps in GRASP. Guys, am I missing something that this is incredibly easy? Allie, are you speaking? They yellowed on you.
Not on purpose, sorry.
Okay, no, that's all right. Okay. Okay, good. Let's look at question 2. Very easy questions, guys, and I'm telling you, 4 or 5 multiple choice questions, maybe more, maybe 5, 6, 7 multiple choice questions in a row, all in one section of the CPA exam. This simple. They're thinking, okay, we've created such a mystery around governmental accounting that people are just going to flip out when they see it. Okay, good, guys. That's less than a minute. That's less than a minute. And I'm starting to think that maybe we got some ones that not paying attention, or if they want to say why they thought it was B, I'm willing to listen to that. But almost everybody else got it correct as C, because we have what? We only have one fund that uses modified accrual, current financial resource, one fund category of the 3 categories, which is what? The governmental funds. Everybody else uses proprietary fiduciary. The person that chose B want to ask a question? Okay, good. Again, guys, I can't stress enough going through and, following along with what we're doing here. Doing that is going to have you quickly go through your homework for chapter 8. Going through your homework quickly for chapter 8 is going to give you free time to what? To go through other, not free time to take a walk on the beach, unfortunately, but free time to what? Sit there and look at other areas that might be a little bit more difficult as you're banking lots and lots of points on the exam. So you should really be stopping anything else you're doing right now and pay attention to this right now, unless you're thinking you don't want to pass the CPA exam. And then I would wonder what you're doing. Period. Okay. All right, good. Now we need to understand budgetary accounting for our governmental funds. Which are governmental funds? Which funds are our governmental funds?
Grasp.
GRASP, good. Our general fund, our special revenue fund, our debt service fund, our capital project fund, our permanent fund. That's what we're talking about here, right? Okay, these concepts that we're going to be looking at here do not apply to the proprietary funds, do not apply to the fiduciary funds, only the governmental funds. Okay, okay, good. So we come over and we take a look and we talk about budgetary accounting is going to be used. We're also going to talk about encumbrance, which is also a budgetary aspect. And then, and the exam doesn't call it actual, but I am, actual activity, okay, which is going to use the current financial resources, measure and modified accrual accounting. Now, I should stop for a second. If any of you are interested in working for the city and county of San Francisco, they have a position called 1649 position. It's an intern position that converts to, it's an accounting position. It converts to a full-time position as long as you don't kill anybody while you're completing the internship. So it's, they call it intern, but it's getting hired at the 1649 position, but you have to pass an exam. The stuff that we're learning in this chapter will cover about probably more than half of what's on that exam. So it wouldn't be a bad thing for you to do. I know some folks are not in the area, but if you're thinking, hey, government, you get a pension, that kind of thing, if that you're thinking that's a career path that you might want to pursue, you should definitely get on the city and county San Francisco's website, see if they have a 1649 exam going to be coming up, and you'd be well advised to go through this material and then take and pass that exam. Some of it is just basic accounting, but much of it is this information. So I think it's worth pointing that out. Okay, good. So having said that, you usually mean to say that at the beginning. Let's just take a look at how we'll do this. Don't worry about this silly Baba thing. Okay, budgetary accounting. Sometimes Garrity, I don't know, he's got some sort of power, and some of his stupid ideas become, pass keys. Meanwhile, they're idiotic. So I didn't say that. Okay, so you come over and they talk about budgetary accounting, and they tell us budgets are based on estimated amounts. Let me just look at my text to see what I wanted to highlight here. So when we're talking about our budgetary accounting, okay, and we talk about budgetary journal entries, okay, so in government, there are specific journal entries for government, and the budgetary process is really called out by the GFOA, the Government Finance Officers Association, and they tell us that the budgetary accounts are opposite in terms of debits and credits from real or actual accounts. So to increase our estimated revenue account, we'll debit it. To increase our appropriations, which is like an estimated expenditure, although we don't call it that, it's really a legal authority to spend, we credit it, okay? And so those entries are recorded at the beginning of the year, where the difference between the two goes to an account called budgetary control. And those entries are recorded at the end of the year, in which they close those beginning of the year entries. So you record it at the beginning and at the end. Now, I want you to flashcard the beginning of the year entry right here, flashcard this, okay? And this government estimated that it'll collect $2 million in revenue. Does that mean they're absolutely going to collect $2 million? No, that means that they have estimated that, okay? Appropriations is legal spending. Okay, this is basically what the legislature has said they can spend on a particular activity. So they credit appropriations. Now, what happens? If a government spends more than it has legally been allowed to spend, what happens? Do they throw people in jail? No, it is not a criminal offense, but it is a civil offense. Civil meaning that what? The city managers could be fined personally for overspending their appropriations. So we're going to see later that we're going to go through quite a bit of trouble to make sure that we don't overspend our legal authority. Now, if this government plans to have more money left over than it is going to spend, it'll have a surplus. That surplus is credited to budgetary control. If this government has planned to spend more than it takes in, that's a deficit, and they will debit budgetary control. And it's one or the other. It can't be both. It either has to be a deficit or a surplus. Now, many state and local governments have a surplus. The federal government always has what? A deficit. And sometimes students think that a deficit is an oops, got a little crazy, oops. It's not an oops. They plan it. They plan to spend more money than they estimate they're going to take in. They plan it, and then they play a little trick on you, and that they establish a law that says that there's a debt ceiling. Meanwhile, they have sat there and already approved spending that they know is going to take them over the debt ceiling. Then when they bump up against the debt ceiling, they start whining in front of you saying, we can't go over the debt ceiling. So they start pointing the finger back and forth at each other that they're going over the debt ceiling and who's causing it. Meanwhile, they all already voted to go over the debt ceiling. We have, guys, a dysfunctional government that is playing a trick on you on a daily basis when it comes to stuff like this. They're doing it on purpose to confuse you so you have no idea what's going on. Okay, so when they start, and I know that they're going to probably be doing this pretty soon, I don't know when it's going to come, they're going to start dragging Biden through the mud, saying that he wants to go over the debt ceiling and he's a tax and spend guy and he's going to go over the debt ceiling. Meanwhile, they're going to go over the debt ceiling because they've already approved spending that will cause them to go over the debt ceiling. Okay, so just keep that in mind when you start hearing that kind of stuff. And it's dangerous because if the government doesn't raise the debt ceiling, then it won't be able to pay off maturing debt, which means the federal government would default on its debt. And if the federal government defaults on its debt, throw away your BEC book, because there'll be no more capital asset pricing model, because there will be no risk-free rate of return, which is tied to treasuries, because now it's not risk-free if the federal government defaults on the debt. That sound you hear is the financial collapse of the US system. They're not going to do that. So they will always raise it eventually because they know they have to, unless you get some crazy people in there that think, you know, that elections aren't real. Then if that happens, then maybe they will let the federal government default on its debt. I don't know. Okay. Anyway, let's stop there. Now, you set this up at the beginning of the year, and then at the end of the year, you simply close it by reversing what you set up at the beginning of the year. Now, sometimes students are annoyed by that, right? We have the beginning of the year, the end of year entry, and once you flashcard both of them, sometimes students are annoyed by that and they're like, oh, government is crazy. Well, look, you're thinking it's crazy, but you always close proprietary accounts at the end of the year, and revenue and expenditure accounts are income statement accounts, aren't they? So you close them at the end of the year. Now, let's kind of dispel some of the confusion that comes in as to why are we doing a debit for revenue and a credit for estimated expenditures, which we call appropriations. Okay, so let's say that we have something called a revenue ledger, which governments do have that. And we have estimated revenue. And at the beginning of the year, you do what to estimate revenue? You debit it, right? We have what? We have actual revenue. Consistent here, John. We have actual revenue, which is still a credit. And then we have what? We have the balance. So when you debit estimated revenue, which we just saw that debit up there, you put a debit in there, right? You just enter that into the ledger now, estimated revenue, right? We debited it. We now have a debit balance of 2 million, don't we? And that sits there as a placeholder now waiting for real revenue. So let's say that this actual revenue. So let's say that this government goes ahead and, I don't know, issues some fishing licenses for, say, $300,000. They'll debit cash. To increase an asset, you still debit it. To increase actual revenue, just like in commercial accounting, just like in introductory accounting, you credit revenue for 300. You go ahead and you put that credit in there. What's the balance in this account now? In this estimated revenue now? 1,700,000. So this government knows, okay, I got 1.7 million left to go. Okay. Then I don't know if that happens, say, you know, January 1st, whatever, or January 30th, let's say. Then on, you know, February 28th, whatever, they get some more money in for their fishing licenses. So they go ahead and they debit cash. just to change the number up this time, I'll make it 200,000. Just making this up. The credit revenue, 200,000. Still using double entry bookkeeping, debits equal credits. I go ahead and I place that credit in here. Now this government knows that it has what? 1.5 million left to go. And so on. Okay, so it shouldn't freak you out that you debit estimated revenue. It's a budgetary account. It's allowing you to track against what? Your actual revenue, which is still a credit, isn't it? Just like it's been since you were 2. Okay. The appropriations work the other way. Since the actual expenditures will be debits, we put a credit there and it serves as a placeholder against what? The actual expenditures that come in as debits. And we'll talk more about that when we, in a little while here. Okay. Okay, good. Now we come over and we have actual activity. Okay. And when we look at our governmental funds have non-exchange revenues. Okay. And the non-exchange revenues mean this. I pay my taxes and I don't necessarily get anything back. And people say, you could tell this, you could say that again, John. Okay, well, look, you get something back, but not immediately. And if, you know, I pay my taxes and I expect the police to be there when I need them, right? Okay, now sometimes people say, well, good luck with that. You know, okay, but we make it home safe most nights, and that's probably because there's police. Otherwise, there'd be complete anarchy out there. Okay, although it's getting bad, but whatever. So you pay your taxes, you expect police service, and you expect the police not to let you fall out of the back of a police car, which I don't know if you saw what happened in Georgia. They arrested a woman, put her in the back of the police car, didn't buckle her in, cuffed her, didn't buckle her in, and forgot to close the door on the other side. And if you've ever been in the back of the police car, which I have, not because I got arrested, but because a police officer gave me a ride when I locked myself out of a garage in Pennsylvania. In Philadelphia, I flagged the guy down. I said, what do? I locked my car in this garage and now the garage is closed. He said, hop in, I'll take you around the corner. It's the same garage outfit. So I noticed at that point that they have plastic seats in the back of a police car. Well, you lay somebody down in the back of a plastic seat. You don't buckle them in. You don't do what? You don't close the door. When you turn the corner, they slide out. And that's what happened to the woman. She slid out dead, died a few days later. Police officers. I mean, when you take a prisoner, which is what that woman would be once they took her, you have responsibility for the safety of that prisoner as a police officer. A young kid, I was telling him what happened, and the kid said to me, if those police had a baby, the baby wouldn't last 2 days. And I was like, you know what? You're right. That's how stupid they are, that they wouldn't be able to have a baby for 2 days, last for 2 days. Anyway, that story just blew me away when I saw what happened. When I get in the car, I turn to everybody and says, everybody buckled in? And I'm just a dummy pulling out of my driveway. Okay, but anyway, how do trained police officers not know that you have to buckle somebody in? Anyway, okay, stop, John. So what happens? My point being, you expect the police to be there when you need them, so they call it non-exchange. You pay your tax with the hope that the government will deliver for you, right? You don't sit there tapping your foot saying, hey, give me some police service, right? Okay, that's why they call it non-exchange. And the non-exchange fall into one of 3 categories: derived non-exchange, still a non-exchange, so they won't put it there. Okay, for example, sales taxes, income taxes. And the reason they call it derived, because the value is derived from some underlying transaction. So when you have value to your property, then the underlying is what? The value of the property. When it's sales tax, the underlying is what? The sale itself, right? So it derives its value from an underlying transaction. That's why they call it derived. imposed non-exchange, and they give us examples here, such as what? Such as property taxes, such as fines. What happens now? And if my camera was on, I'd be pointing to it. The government says to you, what? Your property is worth, oh shit, I just messed myself up. I said property taxes. Income taxes are derived. The underlying is what? Is the earning of your income. So strike what I said about property taxes being derived. The income tax is derived, the underlying being what? The earning of the income. Sales tax, as I said correctly, is what? Is derived, the underlying being the sale. Okay. Imposed, the government tells you the amount. The government says, your property is worth X, pay me 1% of that, or whatever your property tax rate is. Okay, so that's imposed. Fine, you did this wrong, you sped, here's the amount you have to pay. That's why they call them imposed. Okay, now you come over and you take a look at do I want to do this example now or continue? I'm going to continue. I'll come back to this example. You come back to what? Government mandated non-exchange and voluntary non-exchange. Government mandated non-exchange is when a higher level of government mandates certain activity by another level of government and then gives them the money to carry that out. They call that what? Government mandated non-exchange. For example, the state will tell the county, you have to do certain cleanup of water, pollution of water, for example. Now the state can tell the county that because what? The state has responsibility to make sure that one county isn't polluting another county, right? But rather than sit there and say, yeah, clean it up, make it clean, and not giving them any money, the state what? Gives them the money to do it. So it's a revenue, but mandates what they have to do with it, right? And it's considered non-exchange because the state really doesn't, require the lower level government doesn't sit there and say, well, hey, I'm going to only, take this money if you do something for me, right? They tell them they have to do something and they give them the money. Voluntary non-exchange is where the lower level of government applies for money from the higher level, and they hope that they will get that money from the higher level. Good example is community development funds from HUD. So let's say I have a community development project and I want to get some federal money to help with that project. Well, I have to apply for that money from HUD. HUD looks at all the applications. They only have a certain amount of money, and they'll look at all the applications and they'll approve certain ones. And once they run out of money, they draw the line and there's no more money available until the next year, the next round or whatever. Well, that's a voluntary non-exchange, and that I'm hoping that they'll give me that money. When they tell me that they're giving me that money, I can recognize the revenue. Okay. So when we look at these revenue recognition requirements here on this particular slide, we really look at them by this slide that I've shown you on e-learning. We really look at it in terms of what? In terms of the category. Let me go ahead and put this in slideshow mode so it shows a little bigger on the screen. Okay, so we really look at these in terms of categories. So this is a good slide for you to have as a flashcard, because notice it has the 4 categories that we just went through for non-exchange: derived non-exchange, imposed non-exchange, government mandated, which is also non-exchange. Probably should have had non-exchange on this slide. It's going to give me a hard time to write on this. Yes, it is. It doesn't want to give me the pen. Guys, this is not exchange. I don't know what's wrong with this stupid thing, and I don't feel like figuring it out right now. So the government mandated non-exchange, and voluntary non-exchange. These are all non-exchange, okay? Now, you come over, as it says in the heading, and we have the 4 categories. I give you example of what types of items would fall in there, okay? And then I start giving you some revenue recognition criteria. Now, the revenue recognition criteria are eligibility and time. Now, for the derived non-exchange and the opposed non-exchange, there is no eligibility requirement. The government doesn't have to ask itself if it's eligible to collect sales taxes. We know they are. The government doesn't have to ask itself if it's eligible to collect income taxes. We know they are. Go ahead. Try not to pay the government your property taxes. See what happens. So there is no what? There is no eligibility issue that's relevant for derived non-exchange and imposed non-exchange. So we recognize derived non-exchange when the underlying transaction takes place. So let me ask you a question. If a sale takes place in 2022, but the government doesn't get around to collecting that money until, say, March of 2022, would we recognize that revenue in 2022 or in 2023? That's a question. It says recognize revenue when the underlying transaction takes place.
Would it be 2022 then, because the transaction already took place?
Correct. For accrual accounting, which is used at the government-wide level, when I take my general fund, special revenue fund, debt service fund, capital project fund, and permanent fund. And remember, I said that they're going to consolidate those and report them at the government-wide level under that governmental activities column. So if I'm doing that, then correct, Michael, I would recognize what? I would recognize that revenue in 2022 because the sale took place in 2022, right? But if I'm trying to report that at the fund level, say my general fund, I would not take that as a revenue in 2022 because I said they would collect it in March, which would go beyond the 60 days, right? Assuming it was like, say, in the middle of March, whatever. It would go beyond the 60 days, right? Different rule again. Part of your job is to understand the difference between modified accrual and full accrual, right? And here I'm giving you a different way of treating the same transaction under accrual versus what? Versus modified accrual. Question. Okay, good. Impose non-exchange. And we say when use may first begin, and that's relevant to property taxes. So what happens? Governments will mail out their property tax bill prior to the year that they're due. So they mail out their tax bill for their property taxes, say in November of 2022. But the law stipulates that they can't use that money until 2023. Okay, and let's say they're going to collect all that money March 15th of 2023. Even though they mailed the bill out in November of 2022. So what happens? At December 31st, 2022, can we use that money yet? No, because it's what? It's not, let's say they collect all the money in November. It's not what? It's not 2023 yet. So they can't recognize that revenue. Then when the calendar flips over, it is now what? 2023. And for full accrual accounting, they can recognize that revenue because now use may begin. For modified accrual, no. That is going to be what? That is going to be in that case, since use cannot begin until, since it's following 60 days, well, actually I need a more comprehensive example for that, but for, don't worry about, I'm going to show you something else for modified accrual, but for full accrual, I would not be able to recognize that revenue until what? until 2023 when use may begin. For fines, you have to have what? A legally enforceable claim. So if you get a parking ticket on December 31st, but there's a 60-day due process that you have to challenge that or whatever, then the government won't be able to really take that as a revenue until what? Until that next year where you've gone through that due process. Okay. Government mandated non-exchange. We say time and eligibility, but eligibility is really predicated on if it is a reimbursement type of an issue. In other words, you don't get any money until you spend money. So they say we'll reimburse you anything you spend on cleanup, let's say. So they spend $100,000. They can't take the revenue until they've done what? Until they have spent the $100,000. So it's contingent on them spending it. And once they do, they can go ahead, debit expenditure, credit cash, debit the tax receivable, the reimbursement receivable, whatever, and credit the revenue at that time once they've spent the money. That's the only time eligibility comes in. Time, sometimes what will happen is the government, the higher level of government will say, you can only use this money once the state's fiscal year begins. So let's say the county's on a calendar year and they're told, hey, you're going to have some money that's coming and you won't be able to start using it until July 1st, which is the state's fiscal year. Well, they get told that on January 1st. Well, January 1st, they would book the tax receivable, but they can't take the revenue yet because what? It's not July 1st. When the calendar flips over to July 1st, now what? Now they've met the time requirement and they can take that revenue. Okay. And then voluntary non-exchange, now eligibility is relevant. Eligibility is relevant because what? You got to be told that you have been awarded the money. And then they may even have what? A time parameter as to when you can spend that money. Okay, and you can't recognize the revenue until you've met both. Okay, now this is just a high-level summary. We're going to get back into the textbook now and start to take a look at this a little bit more in a little more detail. Okay, so let's just go ahead and get out of this. And your question? Okay, and let's just go back now. And I think what I want to do is look at this now. Okay, so time requirements, as we saw from that slide, are relevant to all categories. Time was on all of them, right? Where is it? Time. Okay, so that what I gave you on that slide is the same thing that's being said right here in the book, which is time is relevant to all four categories of non-exchange. Eligibility requirements, okay, are applicable to what? The government mandated and the voluntary non-exchange, okay, which is what we saw. Okay, now eligibility for the reimbursement could come in for the government mandated. And so as I was sort of talking in the air to you two, but now you can write it here in your book, you would do what? When you spend the money, you would debit expenditure. So you spent, I don't know, 100,000, just making that up. You credit cash 100,000. At that point in time, you what? You have met the eligibility requirements. And so now you could go ahead and do what? Now you could go ahead, and time is probably not a factor here as much for this type of a reimbursement situation, because now you have spent that money. The time is not really relevant here. You can debit, and maybe you'll debit grant receivable because you're going to wait for them to give you that money, and you can credit what? You can credit the revenue at that time. Okay, now we'd say that what? We say that eligibility is really interesting in my mind. The eligibility is interesting for the contingency, which is the voluntary non-exchange. Actions must be taken compliance with usage restriction before revenue is earned. Look, you got to wait for them to tell you that you have been granted that. And when you do, you will debit what? You will debit grant receivable, and you will credit the revenue at that time when they tell you, and I'll just make it a different amount so it doesn't get confused with the other one, that you have been awarded the 10 million, and you have to wait for that to happen. Okay. Now you can see here that what I already showed you on that other slide, that all revenue subject to time, derive imposed, only time, only government mandated and voluntary are subject to eligibility requirements, and what only the voluntary are subject to contingency requirements, basically saying, hey, they've told you that they're going to award you that money in some sort of a grant. Now, what I want to do down here is we talk about measurable and available, and we say upon, and I can go ahead and come back to full screen now. And we say here, upon satisfaction of recognition standards, governmental fund revenue are subject to what? The rule that, and they say when it's measurable and available, which usually means 60 days, but be careful. And we've already talked about that. But let's say it is 2022. And let's say I have sales that occurred in 22, and the sales taxes associated with that are, say, $1 million. Okay. Now, the money isn't collected until March of 2023. So they collect the $1 million, and we'll say March 15. And we'll just say they collect the whole $1 million. Okay. Now, if I'm preparing my government-wide statements, I will go ahead and in 2022, I will debit taxes receivable for $1 million. And I will credit revenue for $1 million because what? The underlying transaction took place in 2022, didn't it?
No space.
What? I'm sorry? Okay, I guess I'm hearing voices again. Okay, so you would go ahead and you would have what? If the question asks you what's the revenue in 2022, is that what am I doing something wrong? 2022? Yeah, 2022. Government-wide answer is what? $1 million? Right? Okay, because the underlying sale took place in $1 million. If they ask me for, say, the general fund, what kind of accounting does the general fund use? What kind of accounting does the general fund use?
Modified accrual.
Under modified accrual, and let's say they're using the 60-day criteria. In 2022, can I recognize the revenue yet?
No,
No, because it's not gonna be collected until beyond the 60 days. But I have to record that I have a receivable coming, because I do know that. And so I would still debit taxes receivable for $1 million. What do I credit? Well, FASB has told us that if you met eligibility but not time, that is going to create a deferred inflow. That's an example of a deferred inflow. So I don't credit unearned revenue. No. I credit what? I credit deferred inflow, because this is what? This is a sales tax. I know I'm eligible, so I don't have to worry about eligibility, and it was only a time requirement. So FASB tells us if you meet eligibility but not time, you should treat that as a deferred inflow. That says deferred inflow of what? Of $1 million. So when I prepare my balance sheet next to my current liabilities, I'm going to show what? Deferred inflow of $1 million. Remember the way the balance sheet looked? We had the deferred inflow next to the liabilities, and I said they're like an unearned revenue, but not quite, because they have these funny rules about time versus eligibility. Okay, so that would be reported there. And then if I ask you here, then when they collect the money, in March, they can do what? In March of 2023 now. Okay, so this would be, this would be at 12/31/22. At 3/15 now, 23, they collect the money. So they get debit cash for what? For $1 million. They credit the taxes receivable for $1 million. Can they recognize the revenue now? Yeah, they've collected it, right? So they will debit what? I'm going to put it blue because I'm going to run into this stupid pink over here. Blue. They will do what? They'll debit deferred inflow for $1 million and credit revenue for $1 million. So what is the revenue that would be reported in the general fund in 2022? Zero. 2023 revenue, because that would open up the 2023 revenue ledger, wouldn't it? Because we close revenue at the end of each year, right? So for the 2023 revenue, now I would report what? $1 million. So you could see 2 questions back to back, maybe 3 questions that say, based on this fact pattern, what would be the revenue recognized at the government-wide level? Answer is going to be what? $1 million. What would be the revenue in 2022 and the general fund? The answer would be what? 0. What would be the revenue? Could be 4 questions in the government-wide based on this for 2023. The answer is 0. What would be the revenue in 2022 for the general fund? The answer would be $1 million, right? Okay. All right. So we're going to continue this conversation. Did I get you through even one module? I did, right? No? Yeah. Did I?
We got through 2.
Yeah.
2? Okay, good.
2.5.
So, okay, good. So do the modules for 5 and 6, guys, and we're going to pick this all up, and I'm going to sort of review a lot of this with you again. And I apologize for the jumping around. Although Tom does a wonderful job, I feel like in the textbook for this part, he kind of jumbled it a bit. And so that's why I'm spending some extra time to kind of clarify where he's going with some of this stuff. Not that the examiners are going to get that heavy off into all this, but I figure there's no reason in not teaching it to you fully since, we've got a lot of point value coming for us. Okay. So I will see you on Tuesday. I'm thinking on Tuesday, we should be able to get through the rest of chapter 8. maybe even make some forays into chapter 9. Our section after that will be to complete chapter 9, go back to chapter 8, and then we're going to have to talk about how we will handle final review, because I think that's going to go beyond the official class time. Okay. All right, guys, I will see you, and hopefully you'll see me next time if my camera's working. I'll see you next time. Okay. Have a good night, guys.
Thank you. Have a good night.
Bye-bye.
Thanks.